Standards are a fact of life. The vehicle that you drive had to meet certain emission standards. Starbucks has standards for the cost of its materials, labor, and overhead. The reason for standards is very simple. They help to ensure that overall product quality is high while keeping costs under control. In this chapter, we will continue the study of controlling cost. You will learn how to evaluate performance using standard cost and a balanced scorecard. Both standards and budgets are predetermined cost, and both contribute to management planning and control. There is a difference, however, in the way the terms are expressed. A standard is a unit amount, whereas a budget is a total amount. For example, if the standard cost of direct labor for a unit of product is $10 and the company produces 5,000 units, the $50,000 of direct labor is the budgeted labor cost. A standard is the budgeted cost per unit of a product. A standard is concerned with each individual cost component that makes up the entire budget. In managerial accounting, standard costs are predetermined unit cost, which companies use as a measure of performance. We focus on manufacturing operations in this chapter, but you should recognize that standard costs also apply to many types of service businesses. Standard costs offer a number of advantages to an organization. The organization will realize these advantages only when the standard costs are carefully established and prudently used. Using standards solely as a way to place blame can have a negative effect on both managers and employees. Companies set standards at one of two levels, ideal or normal. Ideal standards represent optimum levels of performance under perfect operating conditions, whereas normal standards represent efficient levels of performance that are attainable under expected operating conditions. Some managers believe ideal standards will stimulate workers to increase improvement. However, most managers believe that ideal standards lower the morale of the entire workforce because they are difficult, if not impossible, to meet. Very few companies use ideal standards. Most companies that use standards set them at a normal level. Properly set, normal standards should be vigorous but attainable. Normal standards allow for rest periods, machine breakdowns, and other normal contingencies in the production process. In the remainder of this chapter, we will assume that standard costs are set at normal levels. To establish the standard cost of producing a product, it is necessary to establish standards for each manufacturing cost element, direct materials, direct labor, and manufacturing overhead. The standard for each element is derived from the standard price to be paid and the standard quantity to be used. We'll look at data for a beverage company that uses standard cost to measure performance at the production facility of its caffeinated energy drink. It produces 1-gallon containers of concentrated syrup that it sells to coffee and smoothie shops and other retail shops. The syrup is mixed with ice water or ice before serving. The direct materials price standard is the cost per unit of direct materials that should be incurred. This standard is based on the purchasing department's best estimate of the cost of raw materials. The cost is frequently based on current purchase price. The price standard also includes an amount for related costs such as receiving, storing, and handling. The material price standard per pound of material is $3. The direct materials quantity standard is the quantity of direct materials that should be used per unit of finished goods. This standard is expressed as a physical measure, such as pounds or barrels. In setting the standard, management considers both the quality and quantity of materials required to produce the product. The standard includes allowances for unavoidable waste and normal spoilage. The standard direct materials cost per unit is the standard direct materials price of $3 multiplied by the standard direct materials quantity. The standard direct materials cost per gallon is $12. The direct labor price standard is the rate per hour that should be incurred for direct labor. The standard is based on the current wage rates, adjusted for anticipated changes such as cost of living adjustments or COLAs. The price standard also generally includes employer payroll taxes and fringe benefits such as paid holidays and vacations. The direct labor price standard is $15. The direct labor quantity standard is the time that should be required to make 1 unit of the product. Allowances should be made in this standard for rest periods, cleanup, machine setup, and machine downtime. The direct labor quantity standard is 2 hours. The standard direct labor cost per unit is the standard direct labor rate of $15 multiplied by the standard direct labor hours. The standard direct labor cost per gallon is $30. For manufacturing overhead, companies use a standard predetermined overhead rate. This overhead rate is determined by dividing budgeted overhead cost by an expected standard activity index. For example, the index may be standard direct labor hours or standard machine hours. This company uses standard direct labor hours as the activity index. The company expects to produce 13,200 gallons during the year at normal capacity. Since it takes 2 direct labor hours for each gallon, total standard direct labor hours are 26,400, and that's found by taking the 13,200 gallons and multiplying by the 2 hours. Overhead costs are expected to be $132,000. Of that amount, $79,200 are variable and $52,800 are fixed. We divide the overhead cost by the standard direct labor hours to arrive at the standard predetermined overhead rate of $5. The standard manufacturing overhead cost per unit is the predetermined overhead rate of $5 multiplied by the activity index quantity standard. The standard manufacturing overhead cost per gallon is $10, and that is found by taking the $5 per labor hour multiplied by the 2 hours. After a company has established the standard quantity and price per unit of product, it can determine the total standard cost. The total standard cost per unit is the sum of the standard cost of direct materials, direct labor, and manufacturing overhead. The total standard cost per gallon is $52, which is illustrated on the standard cost card. For this exercise, in Part A, you're simply going to calculate a standard cost for 1 unit of product. In Part B, you'll determine the budgeted amounts if the company produces 2,000 units, and you'll have to do that by determining the direct materials, the direct labor, and the manufacturing overhead cost for the production of 2,000 units. The solutions will be provided in the next video.